Many of you would have seen that there's a lot of talk right now in the markets and in the press the world might avoid recession. Now, we really don't think that's the case, and I'm going to try and explain why today. At the same time, despite the fact we're negative about the short-term economy, we think our investments will do very well over the next 3 to 5 years. I'm going to try and explain that too, and I'm going to introduce a concept of earnings yield. The people predicting that the world would avoid recession are extrapolating quite strong economic data today, taking comfort from the fact that the world managed to avoid the worst of the predicted energy crunch over winter, because we had a warm winter in the Northern Hemisphere, and on the basis of that, believing that we're getting close to through the worst and things will recover from here. They're making a few mistakes in our opinion. Firstly, interest rate rises tend to only really affect economies 6, 9 or even 12 months after they occur. So we only got relatively high interest rates towards the end of 2022, so it's much too early to declare victory and think that the interest rates are not going to affect the economy, in our opinion. At the same time, energy prices, we know they're really important, but we can't declare victory there either. The markets are very tight and they could easily tip again, and a new energy crisis could begin with much higher prices. So we mustn't ignore that risk. And the last point is people assume always that economies are linear. So they move gradually in one direction, gradually in another. They're actually highly unstable. So you can get, during good times, a virtuous circle will appear within an economy. But in bad times, things like the housing market will be weak, investment will slow down, there'll be job losses, and then there'll be a reduction in consumer spending, and you get a negative spiral very easily. So it's more helpful to think of the economy as being relatively unstable. So all of those things together mean, in our view, it's much more likely that we'll have a recession than we won't. The way we've built the portfolio and the kind of assets that we're in, we are really confident that we're going to make a good return in the next few years, despite the fact that we think this year is going to be difficult. So we are defensive at the moment, but over time, the assets that we hold, we think will do very well. There's a really simple way of thinking about that in terms of the equities that we hold, and that's earnings yield. So we tend to be very overweight in traditional, defensive, old industries in places like emerging markets in the UK. These are companies trading on 12, 14 times earnings typically. Now, what a lot of people will think, well, what does that mean, trading on 12, 14 times earnings? Well, a nice way of visualizing it is to turn that around. Rather than saying what multiple of earnings are you paying to buy shares, for every pound you buy in shares, what percentage of that are you getting back in terms of earnings? So 12 to 14 times is really like 7 to 8% earnings yield. If you compare that to the bond market or what you might get in interest rates, 7 to 8% is really attractive. And this is in companies that are really geared into the global economy, and they should increase their revenues and profitability over time. So if you think of it in that way and you think, well, we might have a difficult year, but actually we're in assets that we think will outperform, and those assets similarly should actually, on the basis of earnings yield alone, deliver a good return over the next 3 to 5 years. In the bond market, as I've said before on videos, we like the yields that are out there today because we don't think yields can go much higher because there's so much debt. And the yields have risen to the point where bonds are both an attractive investment on their own and they work really well within portfolios. The multi-asset portfolios that we run, bonds are likely to rise in value next time we have a recession, which is exactly what we want them to do. So both bonds and equities we are quite confident about. So despite the fact we expect a recession, which may seem a bit depressing, we are confident about returns, which in the end I think is what really matters. Now, if you have any questions about this, as always, you can get in contact with me directly. I'd love to help you. I must remind you I've been talking about investments and your capital is at risk. And lastly, if you like seeing these videos and you're not subscribed, please click on the flying colours icon here. Thank you.